Okay, so this is the promised video on depreciation, and I created a handy dandy Excel spreadsheet for you to understand. And this is for my finance classes because, and accounting, you need to understand the concept of depreciation. Depreciation has a lot to do with cash flow. It's really also the way the government encourages us to do certain activities in terms of businesses by offering them this tax break, which you get on your mortgage when you can deduct mortgage and interest, right? When you can deduct your principal, when you can deduct your interest payments on your mortgage and your real estate taxes, effectively the government becomes your partner. And let me demonstrate why that is. And it happens in business. So I want to thank the people at the Balance MB because I'm using their website. What was this kind of this text from their website? This woman Jean Murray, thank you. And when you hear depreciation, you're probably thinking of driving off with your new car and it decreases in value. And to some extent, that has something to do with it. But what we're really talking about is businesses are able to take tax deductions on expenses occurred when doing business, but for big purchases, this expense is deducted over time. So depreciation is the recovery of the cost of a property over a number of years. So what depreciation allows us to do is if we bought a building or a truck or you buy a car, over time that building or truck or car should have a lower value, right? Because you're using it, right? As time goes on, your car is worth less, your building is where it gets tricky, but a truck would be worth less. And the IRS allows you to write that off because presumably at the end of the period when you've written that asset off, you need to buy a new one. So the government is kind of encouraging you to invest money in capital assets so you could produce more product and more tax revenues and hire more people, right? So you can't deduct anything that's for your personal use. So if you're a business person who wants to deduct a car because like you're using it personally, or you're deducting furniture, you can deduct equipment, machinery, technology, computers, office furniture, buildings. All this stuff is depreciable as long as you're using it. As long as you're using it in the course of doing your business. You can't deduct land because land usually appreciates. But all these other things that you're using in the course of business that depreciates, you can deduct it. So just keep that in mind. So the IRS says that property must meet the following requirements to claim depreciation. You have to own the property. You can't be leasing a property and then depreciating. The lessor would get that depreciation. That's the benefit to being a lessor, right? The property must be used in a business. If you're not using it in a business and using it personally and trying to deduct it, you're going to have a problem at one point if the IRS catches that. And trust me, the IRS has been collecting taxes a lot longer than you've been paying it, no matter how long you've been paying it. And they have ways of catching this stuff. So I would not ever advocate being less than 100% honest on your taxes. It's the one place you do not want to play around. You have to have a useful life. A building would have a useful life. A car would have a useful life. And it's got to be longer than a year. And it must not be accepted property, such as intangible property, certain term interest, equipment used to build capital improvements. Things like that can't be depreciated. But that gets more into the minutia. There's another kind of cousin to depreciation called amortization. That's when we buy like a company, like say for instance, you went out and bought Coca-Cola, God bless you, and the whole company, and you pay 200 billion for it because that's around where Coca-Cola is trading. Well, maybe 125 or 130 billion of Coca-Cola would be their assets, the buildings, the trucks, the office, and all that other stuff, the distribution. But 30 of, I would say 50 to 60 billion might be the actual Coca-Cola trademarks, which have invaluable value, and you're going to pay for that, and you're able to depreciate that also. But that's for another time. So there's some more information here about depreciation. And how do we calculate it? Well, how we calculate it is the IRS allows many different types of depreciation schedules. So you could do a straight line depreciation, which is so much every year. It's equal depending on the life of the asset. They may have double declining depreciation, which is where you could do it more accelerated. Long story short, without getting into it, again, this is not a tax class, but they were, and very important that you, and I'm going to say this extremely, if you're listening to my video and you're not a student, but you're doing this for business, well, get to your accountant. Do not try to do this stuff on your own. An accountant should be explaining to you what the right depreciation method is. You should not be relying on my video. But there are accelerated depreciation, which is where you can depreciate the asset quicker in the beginning. And remember, our time value of money videos kind of explain how money today is worth more than money tomorrow, depending on the discount rate. So there's a lot that goes on here. Why would the government allow you to accelerate depreciation instead of, let's say I have two buildings, and one building and they're worth $1 million, and one building I can depreciate 10% every year for the next 10 years? Well, I'd get $100,000 a year. If the other one allows me to depreciate in 3 years, I'm getting $333 for the first 3 years, and I'm deducting that from my taxes. That's worth more to me. Why would the government allow that? Generally speaking, they're trying to encourage you to do things. For instance, to build your business in a free enterprise zone or challenged area where they're trying to build up the economy. They may offer better depreciation. Or if you're developing, say, a pharmaceutical to cure like a disease like COVID or AIDS, they may offer you a better depreciation on your assets because they're kind of encouraging you to get into that business. So the government has all ways of changing depreciation schedules, which is probably its own course if I had to teach it. So let's look at the actual numbers. And this is a little calculator I put together. And this would be, we're going to assume a straight line depreciation. So this company built a building for $1 million. I'm going to put a little, make it pretty. I'm going to put a little dollar sign there. And they're going to depreciate it by $100,000 over 10 years. And that would clean up the entire depreciation. There'll be no value. What will happen is at the end, if you refer back to my balance sheet video, you would have, at the end of 10 years, you would have the cost of this building would be zero. The cost basis would be zero because you had written the building down over 10 years. So your earnings before taxes, we're going to assume, is $1 million. So this company made $1 million before they paid their taxes, and they're in the 30% tax rate. So what will their tax be? It's simple. They make $1 million per year. This is very simple, obviously, to explain the concept. And they're going to come up with a $300,000 tax bill. So what's the net to this company after they pay their taxes? They're going to come out with earnings of $700,000. Good year, right? So that would be what it would look like if they didn't depreciate. But now they because they built this building and they paid for it, maybe through bonds or equity financing, they could depreciate. So let's take a look. They can actually say now my earnings before taxes are not $1 million, but I'm able to take out the $100,000 of depreciation expense. This is where the government becomes your partner. So now their earnings before taxes become only $900,000 because they were able to take this expense out. And if you go back to my income statement video, you'll see the same example. You'll see that I took depreciation out of earnings. Now at the same 30% level, and I'm assuming the taxes are the same rate, obviously tax rates change with income, you're going to get a reduced tax because you only have to pay taxes on 900 and not $1 million. So what that does is it gives us a net of 630, right? 900 minus 270 is 630. But again, and I'm going to be doing my next video or 2 videos from now on the statement of cash flows, because once we do our statement of cash flows, we already paid for this. We've either financed it with equity, retained earnings, or debt. So that expense has already happened. So this was really a non-cash expense. Even though I'm able to deduct it, I didn't have to write a check for it. So I add it back to my cash flow. It's a non-cash expense. I've already paid for it. This is just the government encouraging me to build buildings so I can generate more tax rolls. And so effectively, my new cash flow is 730. Now, if you're following this with me, you could see where 730 is different than 700. I've just, by using depreciation, my company has raised an additional 30,000 of cash flow. Or if you want to look at this way, using a formula, if I'm in the 30% tax bracket and I took 100,000 of depreciation, because I would have lost that 30 to taxes, I've created 30 more tax flow. So the equation for this tax shield would be 1 minus your tax rate. It would be 1 minus the tax rate. And since the tax rate is 30%, we're going to say 1 minus, we're going to say what's 1 minus 0.3, and that's going to be 0.7. So that's going to be, I'm sorry, it's going to be 1 minus the reciprocal. It's going to be 30%. So 0.7 is what it's going to cost you, not 0.3. So 0.7 is going to be what it actually costs you to build this building, because you're able to deduct it every year by $100,000. And you collect an additional $30,000 in cash flow, and that's the tax shield. So you've reduced your tax rate by 70%. Okay? By 30%. You reduce your tax rate by 30%. Your effective tax rate is 0.7 of your tax rate. So what's your effective tax rate? Your effective tax rate would be 0.7 times 30 equals 21%. So hopefully go through this. Once again, if you send me your email in the comments section, I will absolutely send you this depreciation schedule. But I'm hoping that that helps you, because quite honestly, this is a very important topic and you need to understand depreciation. So it's part of my finance and accounting, but it's a real important thing to spend some time with. Thank you for listening. And now the next video will be I'll be doing, it will be on retained earnings, and then we'll do a statement of cash flows, which will encompass this. Amortization, by the way, is the same. Thank you.